We've got CPI coming up at 8:30 this morning. Is it still a big deal? Is it still a market mover? Or has SVB just overshadowed the entire thing?
So I think it's still very important for the market. So I think in the very short term, it's probably taken a backseat to some of the other market developments that we've seen. But particularly if we see market conditions calm down, then I think people are really going to pore over the details and really think through this report. And what we're looking for is another really strong print on CPI. So both on the headline basis, but also the core.
Aaron, what about for you? I mean, you're balancing portfolios, you're looking at different things and investment opportunities. Do you believe that CPI still has the same weight on the Fed specifically? Jay Powell, when he testified on Capitol Hill, obviously before SVB, said they were going to watch the jobs report and the CPI report.
Certainly, I think this might be the one report where it is going to be less important, let's say, than we've seen it in prior months. As long as the trend continues, as you know, we've been slowly declining. I think that's going to reassure the Fed. I think obviously right now their most immediate concern are the potential bank failures. And just what we're seeing in the bond market, they're pretty good at predicting what these rate hikes are. And obviously the indications are that they're expecting, something less than 50 bips. Maybe it's 25, maybe it's 0, but that's certainly what the market is expecting.
So, Sarah, let's say we have no hike at all. There is some, potential for that. Obviously, the Fed futures are pricing in some of that. What does that mean for the broader economy? Does that tell the economy one message that kind of goes counter to the Fed saying that they would be steadfast in their plan to reduce inflation?
Well, I think it depends on what we see beyond March. So I think it's very possible that we see the Fed pause for March, let things calm down. And then if you continue to see hot inflation, if the measures put in place by the Fed, the new facility, work at calming those fears, then I think you could see another hike come May. So I don't necessarily think that this spells the end of the tightening cycle. And I think even if it does suggest the Fed needs to be a little bit more cautious with their stance, I think it could end up with the Fed potentially just sitting where they are in terms of the Fed funds rate for a while, that it doesn't necessarily mean cuts. So I think there's still a lot of different scenarios that we could see that could suggest that could still lead to slow downward pressure on inflation.
Sarah, another question for you. A lot of people are saying, well, isn't this what the Fed was trying to do? They continue to hike rates and slow down the economy and I guess test the market. So is this perhaps an unintended consequence here? Or do you think it's an intended consequence, not specifically this, but for something in the market and the economy to break down?
Well, I don't think it was an intended consequence to quote, break anything. But I think what we did see from the Fed is they wanted to tighten financial conditions, since that's through the channel with which monetary policy works. And that would be what puts downward pressure on inflation. So I think tighter financial conditions are a feature, not a bug of Fed policy. But of course, the speed and how quickly we get there matters. And I think what we've seen over the past few days is uncomfortably quick for the Fed.
So, Aaron, I just saw you nod a minute ago when I was saying that to Sarah. Obviously, the loan conditions have changed dramatically since SVB. What is your take as far as finding opportunities in this market now in the wake of SVB? I know you have some picks for us, but just in general, there's certain sectors you're looking at?
Not so much in the U.S. equities right now. I think while it could be a really fast trade to get into some of these regional banks, and there are a bunch of ETFs where you can just buy broadly rather than focusing on individuals, already we're seeing some extended pops for the day. Rather than sort of trade that volatility, I actually like the dollar trade. And so the dollar against the baskets, it actually dropped off rather quickly in the past couple of days, but it's still in a prolonged extended trade. Extended upward since their lows in February. And I think that's another one that you could use a little more long term. You don't have to just trade it for within 2 days. And there's a Wisdom Tree dollar trade ETF that I think you could use just to play off of some of the rate changes and the expectations.
All right, Aaron, we almost got to go, but I want to go through your picks very quickly. Ryanair, LVMH, and Amadeus IT Group. It really seems like you're trying to get out of the U.S. with some of these picks.
I've been a big fan of Europe and just their general outperformance. And despite yesterday's downturn in the European market, they're already looking to rebound part of that for the day. So I'm a big fan of tourism, luxury trades. And even despite a stronger dollar, those stocks
Okay.
have been outperforming their U.S. peers.